Okay. So while we're waiting, I'll just also like, because I see Elvira on the call, and I'll take the opportunity to introduce Gideon and Gideon to Elvira and Andrain and Ether. Gideon is a friend of the house, he's AAPG as well, in and out. I gave a very interesting and fancy introduction the last time about how he was the one who introduced me into all this professional associations. So it's really a pleasure to, just do the handover. Elvira is leading the Sustainable Development Committee this year. Myself and Julian are supporting, and it's been a very interesting season for, I guess, APG as well, with all of the things going on. But Gideon knows all about this stuff. So I won't preach to the choir, but I thought to do that short introduction for how fantastic Gideon has been supporting this course, and him being a friend of, no, he's not a friend of the house, him being a member of the house. So yeah, Elvira, if you can speak.
Yeah,
Um,
hi, how are you? Hi, everyone. Thank you, Thomason, for a great introduction. Welcome, Gideon, or welcome back. It is, you know, this is important and relevant, and I know that's why you're giving your time to be here to help these new professionals to really go into executing their ideas and knowing that the topic is I mean it's important. And thank you. That's all I can say. And yeah, Tumbusum, you're right. Interesting time for APG. And I say for the world, everything is changing so fast. Everything is like, okay, what are we gonna do? It's exactly what it's telling us. So yeah. Well, I hope everyone in the call today just get the best. I just put a note on the WhatsApp, a group. I know that not everyone is just reading it, but for the winners, it is important to be here because it is finances. It's all about the project. It is one of the most important pillars. And even though they win, they have to know how to deal with that, how to deal with the seed money, because most likely it's not gonna be the money, the entire money for their project. So how they're gonna deal with that? And I think this session is gonna be important. And for the all of other participants, believe me that this is one of the most important parts of any project. You can have a great idea, you can have a great social, environmental impact, but if you do not take care of the finances, of the money, you're not gonna land in a good terrain. Your project most likely is not gonna be, first of all, being pitched, being sold, and then if you do that, you're not gonna know how to deal with the everyday execution of any project. So just thank you everyone for being here, and I hope today we had a really good session. I know it will. And for the participants that are here, how long we're gonna wait for them to be
no,
here?
I'm waiting for you to finish your speech so that we can
Okay,
get started.
okay, I'll do. So don't.
This is my
Thank
nice
you.
this is my nice version, waiting patiently for you to finish.
Thank you very much. And with that,
Okay.
thank you to Musum for everything that you're doing. Heather, the staff of APG, and everyone that is involved in this venture lab. Thank you. And saying that, up to you.
Right. Yeah, for the sake of completeness, I would want to read Gideon's profile again so that we can start immediately. So Gideon is in his third decade as a petroleum industry professional and business educator. He has contributed to developing more oil, unlocking new frontiers, evaluating opportunities, and delivering new deals while designing and delivering business impacting learning events. I've been fortunate to work with Gideon for a good number of years because we're both shell together, and he taught me. So I know that the value that he brings to this kind of program. He started at Chevron and then he moved to Shell. So he's bringing cross-sectoral, cross-industry, or cross-company experience and expertise. And across Shell, he has worked in Lagos, in Port Harcourt, in Warri, in The Hague, in London, in the new ventures exploration opportunity identification space and deal delivery team. He now runs his own business. He left Shell in 2015 and runs Rocksolve. Rocksolve is the frontier business consultancy and technology company. The way I like to describe Rocksolve is the pioneer of infusing geoscience and technology together. And he started this way back 2015. He also lectures part-time at a UK university teaching business and management. So he's a member of AAPG, he's a member of numerous other professional bodies, and is an award-winning technical presenter and author. He's a keen golfer and enjoy traveling. So we have the benefit of listening twice to Gideon, and yeah, take it over, Gideon. Thank you so much for your support to this Venture Lab.
Thank you to Boston once again for the invitation. And thanks, Elvira, for reiterating the importance of finance. Like most of you on the call, I also have a geoscience background, but I've been more business in the past 15 years. And the more I do that, like Elvira said, you appreciate the importance of finance in business. So we said the same last week, and today we're going to build on that. So we're going to explore further the subject of finance, and for your ideas and for your ventures. We're going to look into more details now. Today we'll be doing the numbers, what the numbers mean. And we look at an example. I'll use the Rocksolve example at its infancy and how I built a financial model for Rocksolve. Just give an idea of how it really works as a case study. And that will be it for today. So it's, as also just to be clear with Tuboson, I'll be available to support one or two of the ventures who might need a bit of my time outside of this arrangement. So they're more than free to contact me, and we can set up something for me to kind of support them as they work on their financial model. Okay, welcome. Good to see everyone again. I will start sharing my slides now, if that's okay. Thank you very much for using Zoom today. A lot more comfortable. I'm in my environment more than Teams. Okay, good.
Okay, we can see your screen.
That's good.
But you are not in presentation mode. There you are. Okay, try advancing your slides. Perfect. You're good.
Good, good. All right, so well done, everyone. Welcome. We follow on from where we were last week. And remember that we discussed the value of the difference between finance and accounting. So accounting is the record-keeping part of money, and finance is the decision-making part of money. But the record-keeping helps us make decisions, so it goes together. First, we project what the record would look like, which is what financial plan is about. We kind of project how much money we're going to make, how much money we're going to spend, where are we going to raise the money from, what are we going to spend the money on. That's our modeling. That's our financial modeling. And we model it over time. And then when we start running our business, we work with our accountants to get a feedback onto how we're doing regarding our plan. Are we up to the plan? Are we exceeding the plan? Are we below the plan? And we're always reviewing that regularly to make sure that we stay in business. So we're going to look at those numbers or the definition of the documents, the terms in the documents that we use to manage our finances, okay? And this is very important for your ventures and your ideas. So let's start with the financial statement. We'll look at it in two ways. We'll start with what each of the financial statements mean, and there are three of them primarily. So we'll look at the three of them, what each of the statements mean, and then we'll look at why we keep those statements, and then we'll look at definition of each of the elements in those statements, and we'll look at an example. We'll start with a very simple one, just to give us an idea of how it works, and then we'll go into a little more complex one, do a bit of exercise, we'll watch a bit of video, and then we'll look at the financial model, okay? So let's start. Number one of the financial statements that we look at is called the balance sheet. The balance sheet essentially describes three things. First, it describes what we owe, what we own. Those are assets. Now, assets refer to what the business owns. And it describes, it's a list of what we own and what the value of each of them is. So that's the assets. The liabilities is what we owe, what the company or the enterprise owes others, things that the company is, elements that the company is liable for, like your rent for your offices, your payment for your software, and all those elements that you have to pay regularly. We'll look into more detail into subdivisions of this. And then whatever is left when you remove or subtract the liabilities from the assets, that's what's called equity. So equity refers to the difference between, so let's assume you own a house and the house is worth $500,000, but then your mortgage on the house is $400,000. So your liability, therefore, which is what you have to pay back to the bank, is $400,000. The asset itself is $500,000. So your equity, what is yours, is $100,000. So that's just a simplified version of it. But what is important and we need to note is that balance sheet is a snapshot on a particular day. This is very important. So balance sheets are presented as a snapshot on a particular day, usually at the end of the financial year. But you always use the balance sheet to say, on this day, these are the list of the things that I own, these are the list of the things I owe, and this is the difference, which is what it remains for the shareholders. Okay, because the assets and the liabilities belong to the business, which is usually a separate entity from you, the shareholders or the owners. So what is left from what the business owns minus what is owed is what is yours as shareholder equity. And it's usually a snapshot on a particular day. The next statement, it's called the income statement. Now, the income statement, it can be categorized into three main elements. The first one is how much money did the enterprise, the company, make? Now, this is usually over a period of time. This could be 12 months, typically a year, financial year of the company. So in the course of trading for a year, from January to December, for example, how much money was made? That's income. How much money was spent? That's expenses. And then the difference is either profit if it's a positive and loss if it is a negative. So let's assume this venture, this idea, this amazing solar power idea that we've come up with or something like that will make $1 million in a year, but we will spend $1.2 million. So the difference, therefore, is negative 200. So that's a loss. So it offers insights into the business over a period of time. Okay. And then the last one is the cash statement. Now, the cash flow statement, it's very similar to the income statement, if only the business trades entirely in cash. However, because businesses typically don't trade entirely in cash, the income statement is different significantly from the cash flow statement, because the cash flow statement specifically look at money changing hands, money in the bank, money going in and money going out. Now, income, remember, you could categorize an income, but the money is not yet in the bank. Let's assume that the business sold 100,000 worth of solar panels by December the 30th. But December the 30th is the end of the financial year. So the business has to reflect, that we sold $100,000 worth of solar panels, but the money is not yet in the bank because the customer has not paid, or maybe they've paid, but it takes 90 days for the check to clear or whatever. But on the 31st of December, we've filed that we've made $100,000 in sales. But in a cash flow statement, the money is not yet in the bank. So just give us an idea. Now, it's a lot more, it's a lot more complicated depending on the country and the laws of the country where you are trading, in terms of how the accounting laws work in your country, and you should consult an accountant who is qualified to answer all the detailed questions. But at least you have an idea that the income statement is different from the cash flow statement. Now, it goes a bit further than that because the cash flow statement divides the movement of cash into typically three different types of cash flow. One is called the operating cash flow, which is all the cash that flowed in and out of the business based on actual operations. So, for example, we describe a company that is manufacturing and selling solar panels. So in the course of 12 months, this company has manufactured and sold £1 million worth of solar panels. But then they've incurred 1.2 million pounds expenses. So the cash flow, therefore, is 1 million cash in sales, 1.2 million cash out in expenses. So that's for operating. But then to finance that operations, because now you spend more than the money you've made. So there's a loss of 200,000, which you need to finance because you have to find the 200,000 somewhere to continue trading. You spent it. So where did it come from? Well, then we look at another element of the cash flow statement, which is called the financing cash flow part of the statement. Now, financing cash flow looks like only elements of your business that has to do with moving money, raising cash through maybe loan or investment capital from investors. So you look at financing cash flow. So in the same period of time, even though this company has made or delivered sales of $100 million and spent 1.2 million in operating cash flow. Well, for financing cash flow, the company raised debt. They've gone to a bank and they've raised $200,000. So that is cash flow, but that came from financing. But let's also assume that in the same period, the company had maybe through letter of credit, had made a loan to some other company, and those guys also paid you back, which is not from sales from your operations, but from financing. Well, that's cash flow from financing as well. So you could raise cash from either the bank or some of the suppliers, somebody has taken a loan from you and they pay you back. At the same time, you might have paid interest on loan. That's money that's gone out on the other side. So you might have paid interest on loans that is about, let's assume, maybe $50,000. But that's the financing. So that's cash that's not related to operations. It's cash movement that is related only to financing. So loan comes in, loan pay back, loan from a bank, then you paid interest, which is money that has gone out or cash that has gone out in that period. And then lastly, investing cash flow. Well, what does that mean? Let's assume during that period, the company decides to sell one of their assets. This could be physical assets, like properties, like maybe one of the buildings is sold, or it could be investment assets. Maybe the company has bought shares in another company and now they're selling the shares. Well, that's investment or investing cash flow, cash from investing. So the money that comes in from all investment activities. At the same time, in the same year, the company could have been interested in, say, buying shares in, I don't know, Microsoft or something, instead of the money sitting in the bank. And then some investment was made. So cash went out of the business to buy 1,000 Microsoft shares. So that part of cash flow is not operations, it is investing. So balance sheet looks at, on a particular day, what the company owns, the assets, what it owes, the liabilities, and the difference is equity. It could be negative or positive. Income statement is how much the company made, both cash in the bank, but also other sales that have been made, but maybe the money hasn't been paid, but it's income. It's categorized as income. You need to check with your accountant to find out what you can categorize as income, depending on the state, on the country, and what the laws allow you to do. And then expenses as well is money that has been spent or planned to be spent. Also, there are things that you're allowed or not allowed to classify as expenses. You need to check with your accountant. And the difference of that, if it's positive, is profit. If it's negative, is loss. So it gives insight into the business over a period. And then similar to that is cash flow. But cash flow looks at cash through the eyes of operating, financing, and investment. Any questions so far? Let me see if I can see the charts. Yeah, there's a chart. Okay. If someone has a question, you can pop it in before I move on. As I said earlier last week, financing is like a language, or finance is like its own language with its own words that mean specific things. And essentially what you're learning in finance is what the words mean. And so sometimes it might take a bit of a time to get it, but just a very good introduction or simplification of the three types of statements is what I've done here now. Okay, so we're going to move on now. We'll look at the why. So why these three? Why not just one? Why not just two? Why are you interested in understanding this? Well, you need to, as part of building your financial model, but also as part of running your ventures, to understand why you keep these three statements. Okay. All right. So now, why? The balance sheet. Why do we need a record of what we hold and what we own? Well, for a couple of reasons. One, internally. You need to, as a business, check from time to time if you are succeeding or you are failing. So for example, if over time, you notice as a company that your liabilities, what you owe is increasing over time relative to your assets, you want to question, why are we incurring so much cost and we're not having the assets to match that? So you might then need to make changes. If you are succeeding, you're like, yeah, we're doing what's right. If not, then you need to find out why, and then you need to make changes. That's one. Secondly, external, like your investors, those who are investing in your ventures, you will look at your balance sheet from time to time to determine how much or what is available to this business, what assets does this business own that will enable you to continue to trade successfully, and how were they financed? How were they able to raise money to acquire that plant or that property or that asset? So all of that is the reason why you keep a balance sheet. And then when you then play around with some of the ratios, which is a complete separate field of finance, then that will give you vital indicators. It's almost like going to the doctors or to the hospital and getting your vital signs checked, your blood pressure, your other details, your cholesterol, your blood sugar level, and all of that stuff. That's what balance sheet helps you to do. So if you combine some of those figures, you come up with ratios that kind of give you an insight into whether the business is succeeding or failing or needs some health check, need a bit of surgery from the doctor. Okay, so that's for the balance sheet. Then for the income statement, you look at the income statement to understand the operational and financial efficiency. Are you efficient in your use of resources? If you're making so much and you're spending so much, why? If you are spending a lot, if your expenses is far higher than your income, then you need to check that you are inefficient. If your expenses is very low compared to your income, depends on the industry, might be a good thing, might not, depending. But then primarily you could then use that to predict future trajectory. You could say, oh, okay, if last year we spent $1.2 million to make $1 million, then we need to change course next year. We need to reduce expenses, we need to make more money. And that's your job as management, as owners of the business, to go back and say, okay, how are we going to do that? How are we going to make sure that next year we spend less and make more? And that the income statement reveals all of that to you. And when you dig deeper into the statement, you can then identify areas of focus. You can see where most of the expenses are going or where the major expenses are coming from and how to tackle that. You can then decide to either cut spending or determine areas where you try and grow the business a bit more, okay? Because you get that data from your income statement. Good. Next, we're going to look at the cash flow statement. And this one is very, I would say, relatively straightforward, because what is happening is you want to find out if you're positive or negative. That's the first thing. We want to be positive. You want money in the bank. But then the question is, how are you making the money? If your cash is coming from operations, that a lot of the positive cash flow is from operations, then you are excited because what you set out to do is how you're making the money. But if your positive cash flow is coming mostly from investment or from financing, then maybe you're in the wrong business. Maybe you should be doing something else, or you definitely need a new strategy, because you primarily should be making your money from financing and investment. Or maybe the circular in the industry or in the economy meant that you are robust enough to be able to weather it through the dark clouds. And then when the brighter light, the sun comes back, then you are prepared to make money from operations again. But all of that you get by looking at the cash flow statement and determining, oh, okay. So you can see where accounting and finance meets now, because the accountant prepare all this data for you, and you as management should regularly review that so that you know where you are going and whether you are in the right direction or you need to change course. You need to determine your strengths or your weaknesses. Your investors need to look at you and go, oh, okay, this business is generating cash from operations. Oh, no, it's not. It's from finance. That's a bit of a worry. It's from investing. Management, what's your job? So that's why it's important for you to understand that. Okay, that's the what and the why of the financial statements, the three main financial statements. And this applies to both your ventures or any other business whatsoever. Okay, I'll pause again. Any questions? Okay, before we go on,
No
if
questions
I could get
so far.
Okay, that's good. All right. So just a knowledge check. If I could get one or two participants on the call to just type in the chat the three different type of financial statements that you have in a business enterprise. What are the three types of financial statements?
Just to mention that if you don't respond, we will not proceed. So you better respond.
Okay, thank you, Victor, and thank you, Tosin. It's really nice. Well done. Shows that you're not sleeping, so well done. Okay, good. So now that Tosin and Victor has replied, we can now move on. So now we're going to drill deeper into the balance sheet. Okay, we're going to look at typical terms that you thank you, Lisani. We're going to look at some of the words that you will come across as a business person looking at these statements. Okay, so we're going to do deeper now. We start with the balance sheet. The first is we've defined the assets, anything that is owned by the company and holds inherent quantifiable value. Now, this is very important because, as has been shown over time, a lot of financial fraud, some of the companies that have gone under from financial fraud is typically playing with the definition of what is an asset. As I've said earlier, your accountant is the best bet here because these laws or rules change depending on the country, the industry. So you might want to find out what is allowable and how much value can you assign to what you've termed an asset, okay? But what you want to bear in mind, though, is the asset classes are usually divided into two. Current assets are assets that you can typically easily convert to cash within a year. So anything in finance that is the word current refers to 12 months or less. So current assets are anything the company owns that it expects to or can easily be converted into cash within a year. Non-current assets typically are long-term investments or assets that the company owns, but it's not looking to convert to cash in the short term. So, for example, the land, if you come up with patents, trademarks, brands, goodwill, equipment, IP, anything that you're not looking to cash out. For example, if you sell your IP, then you probably lost your business because you can't trade anymore. So those are non-current assets. Similar to that, liabilities are current liabilities. Those are financial and legal obligations that the company holds. Those who are due within a year, rent, salary, interest on loan payment, bills. Those are current liabilities. And those that are due longer than that, 12 months or more, are non-current liabilities. So like property loans, leases, pension provisions, and a couple of other things. Deferred taxes that you're allowed to defer for 12 months or more are referred to as non-current liabilities. What is left of when you subtract the liabilities from the assets is what is called owner's equity, which is what belongs to the shareholders essentially. Now, it could be, as I said, positive or negative, depending. If your liabilities are more than your assets, then you have negative equity. If it is more, if the assets are more than the liabilities, hopefully, which is what you want, then you have positive owner's equity. But that's how you essentially balance the sheet. You balance the sheet with the owner's equity. So you have your assets, you have your liabilities, you subtract it, whatever is left is your owner's equity, which is what you use to balance the sheet. That's why it's called balance sheet. Is assets is equals to liabilities minus equity. Okay. Then the income statement. Now, this is where it gets very interesting. This is a general definitions, but I once again check in your local jurisdiction what you're allowed to call what. Now, revenue is the amount of money the business takes in during the reporting period. So revenue is the same as sales. It's very important to remember what I said earlier, that revenue doesn't equate to cash in the bank, because some sales could be credited before the money is the bank, depending on what you're allowed to do, what you're allowed to classify as revenue before a certain period. Because you have to remember, sometimes you might sell something and then you classify it as revenue, and then later your customers return it. And then what do? So there are rules around how you name what, but I won't go into that today. This is beyond a 2-hour session. Then you have the expenses, which is the money you spend during the reporting period. Then you have cost of goods sold. Now, this is very important to understand. When you define your COGS, it's the cost of the part that it takes to make whatever the business is selling. So to illustrate, if you were manufacturing solar panels, the cost of goods sold will be reflecting only the cost that is related to actual production of the solar panels. Maybe, I don't know, the sand or the equipment that you have to buy. But it won't be things like paying for your lawyer to draft a new contract with your supplier. That's not related to the component that is required to make whatever you're selling. So it's a bit of you have to understand what is allowed and what is not. So secondly, then you also have what is called gross profit. So which is you take out the total revenue less the cost of goods sold. So if you've sold $1 million of solar panels, you look at the exact cost of producing the solar panels. Let's assume it's $500,000, and then what is left is the gross profit. I will show us a simple example after all this explanation, just to retrace some of these points. Okay. And then the next one is income before taxes. So now you've made money you've made some money, revenue. Now you have profit. So some countries or some organizations use the word interchangeably. Technically, they are different, but for the sake of simplicity, imagine the income is the profit. Okay, so the income is profit. So you have operating income. Now, remember earlier we discussed that in cash flow, you have operating cash flow, you have financing cash flow, and you have investment or investing cash flow. And when you are in your income statement, you are looking at the operating income. That is money related directly to the business. So from sales of solar panels. You're not looking at money you've made from selling your shares that you bought in Microsoft the year before. The company has bought some shares in Microsoft and has sold that. No, that's not part of your income. Your income has specifically to do with your operations. So operating income less the operating expenses. The net income, which is income before taxes, less taxes. So, sorry, it's income before taxes, and then operating income less non-operating expenses, because we've taken our operating expenses in the total cost of goods sold. So now income before taxes, operating income less non-operating expenses. The net income is income before taxes less taxes. Then you take all the money you've made, if you are possibly a public company, but if you have shares outstanding because you have investors and they own shares in the company, which I think we discussed last time, then the shares, you divide the income by the total number of shares. So if you have $1 million in net income, but you have 10,000 or 100,000 shares, then earnings per share becomes $10 per share. And then you also have to account for depreciation. So if you bought an asset, maybe a car that you're using to run the business, the following year, that car is worth less. Remember, you have a balance sheet where that car is, you have a value for it, but then you also need to incur costs for the fact that that car has dropped in value. And that's essentially what depreciation is, which you have to account for, okay? So with this simplified understanding, let me allow you to ask a question as well if you have any. Feel free to raise up your hand at any time. Let me see. Okay. Yeah, feel free to raise your hand at any time. I think I can see it here. Yeah. And then I can take any questions. All right. Let's move ahead now. So we're going to go on to so I'm going to use a very simple business. So imagine you're selling food in the city center or town center where you live. And let's assume you're like me, you're a Nigerian, you want to sell jollof rice in the middle of the city center. Here's a simple financial statement of the business, just to drive home some of the points we've made before we look at an actual business after that. So to keep it simple, yeah, you set up a town center food business, you are selling jollof rice and chicken or fish or whatever it is you like. And in the first month or the year, let's assume it's a year, you made sales of £10,000, okay? Now, your expenses are for cost of goods sold, which I mentioned earlier. You are looking at only the cost of the ingredients that's gone into preparing the food over the course of the period. So let's assume you spend £3,000 to buy the ingredients, so that's the cost of goods. So your gross profit, therefore, would be 10,000 less 3,000, which is then 7,000. Then you look at the operating profit or income, which is this, less the non-operating expenses, which is other expenses apart from cost of goods sold, such as paying salary, renting space. So let's assume that costs 4,000. So you have the net profit or net income of 3,000. And then you pay tax, interest on loans of 1,000. And then you have a net profit of 2,000. So just to keep it simple, therefore, the main element in your income statement or your financial statement in this business will be sales, cost of goods sold, gross profit, which is sales less cost of goods, operating profit, which is gross profit less other operating expenses, net profit, which is operating profit less tax, interest, and all of that, and you have a net profit. Now, we're going to watch a video that's 10 minutes video that goes deeper into everything I've explained and some more. And then after that, we're going to look at the financials of a particular company, a local company near where I live in the UK called Drinks. It's relatively simple. There are some questions there, so we'll do a bit of activity and we interact with both audio and the text, which you can put your answers in the text, and then we'll discuss that, okay? So we're going to watch a video now, and then we'll take some questions after that.
80% of your results come from 20% of your effort.
I need to Yeah, stop share, change share.
When you share, I think that there's an option at the top that allows you to change the audio.
Yeah, okay. Let's just sort that out now. Thank you. Yeah, I'm here. Good. Okay. Yeah. Can everyone see my?
What is a balance sheet and how can I read a
We can see it and hear it.
What is a balance sheet and how can I read a balance sheet to learn more about the financial situation of a company? What do the various financial terms on the balance sheet mean and how do I understand the full picture? The balance sheet is an overview of what a company owns and what a company owes at a point in time. What is owned is on the left, what is owed is on the right. The balance sheet is one of three very useful financial statements that a company puts together and publishes. The other two financial statements are the income statement, an overview of the profit or income that the company generates during a period, and the cash flow statement, an overview of how much cash the company generates and where it spends that cash during a period. The balance sheet is a statement of the financial position at a point in time, so it's like a picture. The income statement and cash flow statement both cover the flow during a certain period, usually a month, a quarter or a year, so they are like a movie, each with its own focus. When reading a balance sheet, it is important to start off by looking at the balance sheet by category. Current assets and non-current assets on the left. Current liabilities, non-current liabilities and equity on the right. Current assets are cash and other assets that are expected to be converted to cash within a year. Non-current assets are longer-term investments that cannot be converted into cash quickly. Current liabilities are amounts due to be paid to creditors within 12 months. Non-current liabilities are amounts owed that are to be paid after the period of 1 year. Equity on the balance sheet is the book value of the shareholder capital. That's how the balance sheet works on the conceptual level. Let's now look into the balance sheet of a real-world company. Retail company Walmart. Walmart's fiscal year runs from February through January, so we'll be reviewing the year-end balance sheet of January 31st, 2020. Current assets 61.8 billion. Non-current assets 174.7 billion, adding up to total assets of $236.5 billion. Current liabilities 77.8 billion. Non-current liabilities 77.1 billion. Equity 81.6 billion. And as the word balance sheet suggests, the total amount owned equals the total amount owed. Per the accounting equation, assets equal liabilities plus equity. Let's zoom into the balance sheet in more detail and review what is in each of the balance sheet categories. Current assets, non-current assets, current liabilities, non-current liabilities, and equity. Same 5 categories, just a lot more detail to dig into. In the American format of the balance sheet, assets are listed from most liquid to least liquid. Liabilities are listed from due first to due last. I will take you through the main line items. Cash is the most liquid asset. $9 billion in cash and cash equivalents might sound like a lot of money in absolute terms, but relative to the size of Walmart's operations, with $520 billion in annual net sales, this balance is actually relatively small. Receivables is the next most liquid asset, as it is very close to cash. You might ask yourself, how come Walmart has receivables? Don't we, the consumers, all pay cash or by card when we shop? True. Receivables at Walmart are primarily due from insurance companies resulting from pharmacy sales, banks for customer credit and debit cards, and electronic bank transfers that take in excess of 7 days to process, governments for income taxes, suppliers for marketing or incentive programs, and real estate transactions. This kind of information can be found in the notes to the financial statements. As you would expect, inventories, the goods that Walmart holds to sell, are a very big amount, $44 billion. Property and equipment, in non-current assets is the single largest line item among the assets on Walmart's balance sheet. $105 billion. Land, buildings.
The hardest part about a writing assignment is getting started. I'll use Grammarly to illustrate how AI can be your brain.
Fixtures and equipment, transportation equipment, and construction in progress. Property and equipment is a non-current asset, as it is a long-term investment, with estimated useful lives of certain asset classes up to 30 or even 40 years. Operating leases and financial leases are new line items on the balance sheet, since the recent introduction of the new leasing standard ASC 842. Whereas leases used to be off balance sheet, the new accounting standard requires lessees to recognize right-of-use assets and lease liabilities on their balance sheets. For Walmart, in terms of the amounts, the lease assets are pretty much offset by the short-term lease obligations and long-term lease obligations. Net impact on the balance sheet, zero. But what is owned and what is owed, now explicitly spelled out. The goodwill on Walmart's balance sheet is primarily related to Walmart International, the difference between the purchase price paid for retail operations that Walmart acquired and the fair value of the net assets acquired in the business combination. Now that we know what the main line items on the asset side of the balance sheet mean, it is important to put things in perspective by clearly identifying the top 3 items in terms of size. Property and equipment, $105 billion. Inventories, $44 billion. Goodwill, $31 billion. That's more than 75% of the value of the assets in just 3 lines. Onto the liabilities and equity side of the balance sheet. Accounts payable. Invoices received from suppliers, but not paid yet, $47 billion. Accrued liabilities, per the notes to the financial statements, consists of, amongst others, accrued wages and benefits, insurance-related liabilities, accrued taxes, such as payroll and sales tax, and deferred gift card revenue, totaling $22 billion. Long-term debt due within 1 year is exactly what it says. That part of the long-term debt that is to be repaid or renewed within 1 year. Long-term debt of $44 billion is US dollar, euro, sterling or yen denominated debt with maturity dates up to 30 years in the future, per the notes to the financial statements. Within equity, the book value of the shareholder capital, the largest line item in dollar size is retained earnings, the part of the company's cumulative historical profits that has not been distributed to shareholders through a dividend. Another interesting one is non-controlling interest. Most of this, $4.3 billion, is related to Walmart's acquisition in August 2018 of a majority stake in Flipkart, an Indian-based e-commerce marketplace. The non-controlling interest is the part of the shareholder capital of Flipkart that Walmart didn't buy, but somehow has to account for. In the acquisition, Walmart assumed the assets as well as the liabilities of Flipkart, and through the line non-controlling interest has to represent that it doesn't own all of the equity in the subsidiary. On the liabilities and equity side of the balance sheet, the top 3 in terms of size are equity of $82 billion, accounts payable of $47 billion, and long-term debt of $44 billion. Here's the next level of understanding of the balance sheet, comparing what you find on the left and what you find on the right. In the area of working capital management, Walmart's inventory balance of $44 billion is financed by Walmart's suppliers through accounts payable of $47 billion. The balance sheet, an overview of what a company owns and what a company owes at a point in time, which can tell very interesting stories about the financial situation of a company. If you have any questions about the balance sheet, then please post them in the comments below. Want to learn more about business, finance, accounting and investing? Then subscribe to the Finance Storyteller YouTube channel and start watching the next video in the recommendations on the screen. Thank you.
Okay, welcome back, everyone. So if you have any questions so far, which I can guarantee you, it seems a lot, and as you watched in the video, beyond the fundamentals of what I've explained earlier, digging deep into it takes you into sections of the industry, the laws of the land, and usually these reports are supported by detailed notes for each line item, which you then use to understand when the company says that, what does that mean? That, what does that mean? But so far, any questions, just to, before we go ahead?
We are done. I think we can also proceed for time.
Okay, that's good, thank you. So now we'll back to the PowerPoint slides. Okay, so now what we're going to do is we're going to review another business. So you saw how the video reviewed Walmart's accounting or financial statement, balance sheet primarily. Now we're going to look at the income statement of a local business near where I live in the UK. So here, remember, income statement is about profit and loss, or revenue, expenses, or sales costs, and the profit and loss. So we're going to look at the revenue and expenses for a local business. And so the business is Dela Drinks. They're a major alcohol supplier to the local pubs in the area. So for the year 2020, the business turned over 32 million, relative to 2019, where it turned over 31 million. Now, the cost of sales, which is buying the drinks that is selling on to the pubs, is 25, and that's why it's in brackets. So 25 million, 25.6 million pounds is the cost of sales, which is similar to 2019. But because for some reason they made more money, probably by increasing the price, the gross profit is a lot more. So the gross profit is then 6.6 million. But then there are other operating expenses that are not included in the cost of sales. So distribution costs, they have these trucks that they use to transport the drinks and take them to the pubs and the hotels. So that's 3.6 million. They have other administrative expenses, so they pay the staff, the drivers, the receptionists, and all of that, 1.8. So the operating profit, so all the profit from the operations is 1.1 million. Now, I will leave you for the next 2 minutes to look at the rest of the income statement of Dela. So we look at balance sheet of Walmart earlier in the video, and we're looking at the income statement of Dela. And here are 3 questions. I would like you to read the balance sheet, 5 minutes exercise, look at it, and then go in the chart and try and answer those 3 questions. Number 1, why is there a reduced net profit? So if you come to a net profit here, in 2020, even though the turnover is higher. So in 2020, the business made 32 million, but the profit before tax was 793 instead of 907. Why is that? Look for the answer. Secondly, why are they paying more tax even though the profit is less? So they made 793, but then they're paying 2010 tax on profit. What could be the reason? Just answer an answer, put it there, and look down there and check how did the owners of the business pay themselves. So I'll give you 5 minutes to do that, and then put the notes in the chat, and then we'll have a discussion about that. Is that clear? Any questions on that? I get that's clear, so I'll be looking forward to hearing from you, to seeing your notes in the chat section.
Okay, so I think we have 2 more minutes left. So let's start dropping our comments, or if you would like to speak. But we have 2 more minutes left. Thank you.
We haven't even had one comment actually. So just to call it out as it is, thanks, Anne, for amplifying that. So looking out to you, Lisani, Olajide, Samuel, Tosin, Victor, Uzoma, please, we had a question to be answered and put on the chat. So let's do that.
And if you're not clear, you can feel free to discuss it and say, you know what, I don't really understand this bit. Then I can kind of explain a bit more. But there's nothing beats looking at the financial statement, try and make sense of it yourself. That's the best way you understand some of these terms. So if you're struggling with any part of it, don't worry, just shout out, ask a question, you know, unmute yourself, then I can explain a bit more.
Okay, let's do like a knowledge check. Oh, okay. I was worried, but now we have some
Okay, all right,
responses.
good.
Yeah, right.
Oh, well done, Victor. I like that. So that, yeah, that's it. You got it. So it's actually very simple. The first one, you got it. So there was an acquisition, and the impact of that acquisition is what dropped the profits from 2020. Well done. Anyone else spotted that as well? And you were right, some of the expenses as well. Yeah. Tosin, yeah. Yeah, that's it. Impact of acquisition, acquired subsidiaries. Yeah, very good. Well done. Thank you, Tosin. Thank you, Victor. And you were right, some of the expenses were more as well. The administrative expenses has gone up by about 200,000 as well. But even at that, the operating profit was still higher. But then, yeah, the big item is the impact on the acquisition of subsidiary. Okay. So we've got 2 responses. I think we can move on for this due to time. Well done, everyone. So now we have we have profit before tax, and then we have the tax. So the second question is why are they paying more tax in 2020 even though the total is less? Well, this is where the question of notes come in, and I will show you the notes now on the next slide. So just take a look at that. Let me see. Okay, good. So now you've got the notes. You can see the notes on number 11, taxation. And you can see from here that the tax due, number 11, you can see the tax on profit is more, even though the profit is less. But when you go to note number 11, you can see the answer there. And once again, I will ask us, based on the notes, why are they paying more tax on profit again? Can you observe anything here that gives you insight into why the tax is more, even though you have one thing here, but there are maybe another thing else that wasn't mentioned here, but at least there's one thing that you can observe here. What is that? Can you see it? Yeah, Uzoma, thank you very much. Very, very good comment on how the owners pay themselves. Yeah, you're right. So they pay themselves through first dividends, as you rightly said, 100,000, but also administrative expenses as well. Because I know the gentlemen who own the business, they work on business as well as directors, and mostly the managers in the office as well, the 2 of them. So you're right. So they pay themselves as administrative expenses and also take some money out as dividend. Well done, Uzoma. Good answer. So now we have the notes on taxation. And the next question is, why is the tax higher in 2020, even though the profit is less than in 2019? So let's have that note as well. Under 5 minutes to do that. Yes, Uzoma, thank you very much. So yeah, so the government of the United Kingdom has increased or progressively been increasing the tax rate from 19% to 25%. So the rate of tax was higher. Thank you, Samuel. Thank you, Tosin, as well. So the rate of tax was higher. But then there's also an element there in the deferred tax element. Did you notice the big difference? Yeah, thank you, Victor. So the deferred tax element was much, much higher than in 2020 compared to 2019. So a combination of those two meant that the tax paid was higher on the profit, even though the company made less profit than 2019. Thank you, everyone, for your comment. Well done, everyone. So with this now, we've established that you guys are now comfortable. You kind of get the idea now that once you understand the fundamentals of this financial statements, by reading the financial statements, you're understanding the business. You understand how the business made money, what to spend money on, is it being efficiently run, or is it not efficiently run? So if I just throw the question out there now to everyone, and feel free to comment, would you say that Dialer Drinks is an efficiently run company? What would you say and why? Feel free to make comments. Would you say this company is efficiently run, yes or no? Would you say, based on the two income statements that we have in front of us, 2019 and 2020, would you say Dialer Drinks is an efficiently run company? Okay, Lisani, you said no. Do you want to comment why you think it's not efficiently or efficiently run? Victor says yes. You want to leave a line on why you think so or not? I'm just interested in seeing what you think. You are now the investors. Someone is presenting this company to you and you're looking at the books. So let me know what you think. Should we sack management? Should we encourage them? Should we give them more bonus? Okay, Lisani said they've incurred more tax. That's interesting. Okay. Well, I could see why, but when you kind of think that tax is a little less it's out of your control, really. The government of the United Kingdom is taxing people at about, yeah, Tosin said there is no significant increase in net profit. Yeah, that's interesting. Yeah, but based on why there was no significant increase in net profit, what do you think, Tosin? Because you look at the reason is they've acquired a subsidiary. Is that a good thing or a bad thing? When you think, does that indicate sign of growth that they are trying to grow the company by acquiring a new subsidiary? So in 2021, with the new acquisition, which means they're expanding. So that it's a good thing, although they make less profit this year, but next year they will make more sales and profit, and they're taking out the competitor. Maybe they could charge more because the competitor has been taken out by acquisition. Can you see where I'm coming with that? Well done. Keep your comments coming. Well, yeah, Lisani, you're right. Could be due to high social or environmental impact, or as in the case in the UK, the government just tax your profit anyway. You declare a number, they slap a percentage on it. And right now it's 25%. So you make 100,000 or £1 million, government takes 250,000 pounds, whether you have high social or environmental impact. So yeah, I can understand where you're coming from, Lisani, but sadly in this case, I'm not arguing for Dialer. I'm putting context in your comments. So well done, keep it coming. Okay, I like that, to avoid penalties. I agree with you because they deferred £40,000, which is why the net profit was less. So they want to make sure they are on top of that and make sure they don't defer as much tax as they've done in 2020, which is good. So that's a good point to Zoma for bringing that out. It's very nice. Victor says, yeah, they will make more profit due to the subsidiary. I agree with you. That's my take as well. That although the profit is after tax is less in this case, but they've acquired a subsidiary, and so hopefully they will keep growing the revenue, and then the profit will follow. Well done, everyone. But there's one thing that I really like towards the end. Okay. Okay, Samuel. Yeah, that's true. But once again, as I've explained, you might want to look at tax from not their fault, but the government increasing the tax. So yeah, it can go both ways. But if anyone looks further bottom down, I like the retained earnings at the end of the year. Why is that important that the company retain earnings at the end of the year? What does that say about management? Yeah, that's true, Tosi. Well done. I like that. Yeah. So we're looking for their 2021, 2022 and see how that subsidiary impacts the business. Yeah. So we reserve the judgment for that. But what about the retained earnings? Yeah, I agree with you, Zoma. They're very frugal in spending. They made 6.6 million gross profit, 1.1 operating profit. Administrative expenses were kept reasonably low. Distribution cost was also kept reasonably low. And I've physically been to this company, so I know the place, I know the people. So yeah, you're right. The office is not fancy. The owners have a little cubicle office on the side. They're not building a massive, giant, fancy office. You know, so yeah, you're right. I've seen the guys firsthand and they're very frugal in their spending. But I'm really impressed with their retained earnings relative to their turnover. But the question I want to ask us is, as investors, the company is making $32 million, 32 million pounds, but they are keeping 5.8 million pounds. That's over, what's the word now? That's about 12, 15%. What do you think of that? Keeping that much profit? Should they keep that? Should they not? What do we say? Any comments on that? Because what you will be doing, and thank you all of you for your engagement on this one, really good. Because in your ventures, you will be creating this, but projecting it forward. So now we're looking at Dialer, we're looking at Dialer drinks backward. So we're looking at what you've done in the past. Well, what you're doing is the opposite. You are projecting your sales, your expenses. So your investors will be doing exactly what you're doing right now. And that's why I was interested in us doing this exercise. So that you will be seeing what the financial, your story will be telling your potential investors. Are you a responsible, are you going to be a responsible company? Will you be spending all the money? Are you going to be frugal? What kind of decisions will you be making? And the whole idea with what you've done today, and it's amazing with your comment, is to show you that is how your investors will look at your financial projections as well. And this is exactly what you're going to do with your financial modeling. You're going to prepare this statement, but looking ahead. So what we're going to do now for the rest of the session is to look at how to, so once again, thank you, everyone. Look at how to do this, but projecting forward. And that's what financial modeling is all about. It's about projecting forward, and then you can play with sensitivity analysis is to say, okay, if I could reduce my tax burden or reduce expenses, what would the profit look like? What would the revenue look like? And that's the kind of sensitivity analysis that you will be playing on your ventures. And this is where this is the kind of thing that I will expect you to take away after today, to have a go at it, and then you and I can sit down together and look at what you are projecting or what you are planning, and we could have a conversation about it. So we're not going to do it all today, but I will show you an example of how I did it when I started my journey with Rocksolve. And this was what I was showing to investors. And you can take away from that and go, okay, so this kind of thing I need to prepare as well and show investors for the next round of your venture lab support. Okay. Once again, I've got here, let's see, okay, let's move that here. So I've got here three companies, but the statement has been produced as a percentage, okay, as a percentage of unit sales. So let's assume they've made 100, which is not what they've made, but the percentage of the revenue gives you an idea of the efficiency of the companies. So what do I mean by that? So you have Sainsbury's, 2016 to 2018. Sainsbury's is a supermarket chain in the UK. They are competitors, so Sainsbury's, Morrison's, and Tesco's. They are big supermarket chains in the UK, like Walmart in America, Target, and all these other companies, and then like ShopRite in Nigeria, and Cash and Carry, and all of that. So they are big supermarket chains. Now, So now look, this is one area, this is one use of financial statements. When you convert them to ratios, it helps you to see or to watch out or analyze efficiency in organizations. So you have Tesco 2016 to 2018, Morrison's 2016 to 2018, Sainsbury's 2016 to 2018. The revenue is 100, so we've normalized revenue to 100, and these are the percentages or ratio of that. Now look at the cost of sales. Which company would you say is incurring less costs of sales, which is good? Which one would you say is good and which one is bad in this category in terms of cost of sales? Yeah, thank you, Tosin, for your comment on retained earnings. Really good. Yeah, thank you so much as well. Yeah, well done. It's very good. Retained earnings is very good. I like that. Okay, so based on these numbers, which of this company is efficiently reducing cost of sales, which is very important as a ratio, a percentage of revenue? Which one is good in that regard? Yeah, thank you. Sainsbury's is leading. No wonder it's then reflected in their gross profit, because then they are making more money gross because they are incurring less cost of sales. Well done. And then Tesco is second and Morrison is third. Then we go to another important one, which is operating expenses. Who is doing very well in this regard and who is not doing so well over the 3 years? Yeah. So we've got, you look at the operating expenses. So Sainsbury from 3.6 to 5, so it's actually going up. Morrison is reducing the operating expenses, so is Tesco. So then look at the operating income, and you can see that Sainsbury is reducing the operating income over time. They were 1.6 by 2018. Meanwhile, Tesco is growing theirs to 2.8. So what does this tell us then? Well, this tells us that, yeah, that it's not enough. So you see how all of these numbers matter, okay? So while Sainsbury is great with the cost of sales, but the operating expense is higher, and they're increasing it instead of reducing it. And then you can see companies like Tesco doing so well, and their income is increasing. Then you look at the cost of financing. So they've gone to the bank or shares or wherever. You can see that Sainsbury is not incurring as much costs relative to their sales, but Tesco is quite incurring a lot of costs, although they are reducing it from their financing. And then they're making other money as well. So Sainsbury is into other things apart from selling stuff. So they've got banks and other kind of source of income. Same thing with Morrison, not so with Tesco's. When you come to the income before tax, or let's just go straight to net income, you can see that this is the important point. Over the 3-year period, although Sainsbury is starting higher, but you can see that they are dropping. Yeah, thank you, Samuel. Morrison is doing well. Yeah, lowest operating expense. So over the 3-year period, you can see that Sainsbury is dropping in net income from 2% of their revenue to 1.1. Morrison is moving from 1.3 to at least 1.8, 1.9. But Tesco is making the biggest gain. They've gone from 0.6 in 2016, a percentage of their sales, to 1.5. So based on this 3-year analysis, you can see that by looking at each of those elements, we are already, as a group, analyzing these 3 companies and coming to conclusions. And that's exactly how it works in the investment world. When you present your idea, your venture to investors, they will be comparing you to others in your similar space and looking at how your projections stack up. And that's why you should do the homework before you go and meet your investors. You should find out what others in your space are doing. Look into records, financial records of companies in your space. Even if they are bigger than you can do a ratio analysis, a percentage analysis, to have an idea of what the numbers are. And you could present them as well to make the life of your investors easier, to show them that you're going to be efficient in operating expenses, in your cost of sales, and that you generate net income to keep the business going. Any questions?
No question from me, but process check. Really, we are about 1.5 hours in, so just to keep you informed.
Brilliant, thank you. Okay, so we're almost there. Before I go on, thank you very much, Bosun, for that. I will just mention this briefly. I assume that a part of the venture lab will be covering the business model canvas or some elements of it. But the idea is part of presenting your financial model requires that you understand all these elements. So this is a business model canvas. Is an idea that is very well adopted in the business startup space, where you define your key partners, your key activities, your key resources, your value propositions, your customer relationships, your channels through which you are going to go to the market, the different segments that you're going to address, your cost structure, and your revenue streams. So the idea with the business model canvas is that once you have a very good cost structure, revenue streams, and then you define how that comes together, using this, you can essentially create a business plan or your presentation to your investors using all these sub-headers. Your key partners, activity, resources, all of these, discuss them per slide, your cost structure and everything. And that then feeds into your financial model, okay? Okay. So in order to manage your finances or to build your financial model with sensitivity analysis, I will use an example of Roxol, which is something I built. This is not relevant. It was 7 years ago or 8 years ago. Sorry, 9 years ago. But it shows you an example of how to build it at a startup when you are starting out, okay? Whether you realize them is a different ball game, or at least if you project to investors that you understand finance, and hopefully the past 2 sessions have kind of prepared you to do something similar, and I'm more than happy to support you. So before you begin, you want to be clear what the vision of your venture is about. As Bosun mentioned, part of the strategy I had was to create that, bring geology along in the technology space a little bit. That was kind of like the goal, the vision of the company. And then we started dealing into a bit of finance now. Now, one of the things you want to define in your modeling is the size of the market. And this is very important because you want the investors to get a size of the whole pie. Now, you're not going to win everything. You're not going to go out there and be 100% of the market. That's not realistic. But you're going to say, look, this is the size of the market. These are technology companies already in the geology space. This is what they do. This is the size of it. And this is the part we want to address, okay? So at the time, looking at software as a service, geological solutions from cloud, mobile, machine learning, AI, and blockchain, the size of the market, which was based on analysis and research, was £8 billion, which essentially the revenue that other companies in this space are generating in a year. So in a year, 8 billion. A market size, remember, is always a number, a financial number. So market size is a financial number. The total number of revenue happening in the space you are. So if you want to sell a solar panels, well, what's the total size of solar panels sold in a year? If you want to sell electric vehicles, what is the size of electric vehicles being sold in a year? So that's your market size, all right? And then you want to also do some analysis of your customers. How much are they spending on what you are trying to sell? So this is the total budget, annual budget devoted to geological solutions, estimated based on research as well. So asset managers at the time were spending about $400 million. Exploration managers were spending 500 million. License managers in IT were spending 70 million, and the academia as well was spending some money. And these are all kind of the work you should be doing. So now You then go, okay, people are spending all this money, but what are they really spending it on? What companies are you looking at that are going to buy these things that you're trying to put together? So at the time, based on data that was available from the USGS, first you have the size of companies in the space at the time when Rocksoft was being formed. And in the crude petroleum and natural gas sector, companies with less than 100 employees were 6,349 companies, okay? So small companies that Rocksoft was planning to target globally was were about 6,005. Then those with less than 500, 87, less than 1,000, 24, less than 1,005, 10, less than 2,010, less than 2,500, and the big ones, the Shells, the Chevrons, the really big ones are 21 companies with 5,000 plus employees. So therefore, when you total the number, you're saying, hey, wait a minute, we've got an opportunity here to sell to over 6,000 companies, okay? And then you start looking at them, you think, all right, 6,500 companies, different sizes, but what is the typical user story of each company, of each customer? What's the experience like? So you then create these user stories using generic names. They don't have to be real people, but just let's assume, okay? One of the customer type is an exploration team leader. Let's assume Becky is the name. She works for Optimum Petroleum. Well, she wants to access geological intelligence. There's a reservoir geologist. So Wahid is his name. He works for Tullow, is an independent. He needs access to geological data. Another customer type, the user story, is Charles. He's the license manager for the Nigerian regulators. He needs to create a database of all the rocks to assist or attract interest in the oil block. So when you create those user stories, your investors get an idea that you kind of get your stories together. You know where your customers are, what segments they are. And then there are other user types that Rocksoft identified at the time. You have university students, you have academics, you have training managers as well. So we kind of say, these are the customer types that the company is looking at. So you need to do a picture like that of what size of the market you're looking at and the type of customers that are in that space. And then you start punching some numbers. Now, this number here is the total addressable market, TAM, T-A-M. Based on your business model, based on what products you're selling, how many users based on your user story, you are projecting we need your service, you then create a total addressable market potential based on your business model. So for example, Rocksoft revenue stream at the time, it's not what we do now, but at the time when I was still younger and had a lot of energy, we were going to sell license and project fees, okay? And we said, well, for academia, we're not going to charge them project fees. It's always going to be licenses. This is the cost, and we're looking at this many users per year. This is the goal and the target. Government agencies, we're going to send them a couple of licenses, but we'll do a lot of projects for them. So we're looking at 20 agency projects paying £1 million per. That was the plan. Of course, we didn't make these plans, but you need to project. This was the vision. This was where we're going to be. This is what you want to be. Big companies with over 500 employees, based on 12,000 users at 1,002 and 15 projects. This is how much we're projecting. And the small companies based on this number of users at this price for this number of projects. So you project, and then you come up with a number. Based on all of these, at the time, 113 million, which is reasonable because remember, we mentioned earlier that the size of the market was 8 billion. And as a startup, over the next 5 years, we are projecting to address a market size of 113 million. So this is how you prepare a financial model for your venture. This is how much we want to address. Based on this, we could be making this much money, 5-10 years down the line, whatever you're projecting to cover. This is the size of the market that you want to address. That's why it's referred to as total addressable market, TAM. It's a potential based on the business model, which you have to come up with. And then you do a SWOT analysis, the strengths of your company, the weaknesses, the opportunities, and the threats, which is a business part of it, which I guess the venture lab will be also teaching you that, not so much. But you put all of that in to inform your investors of your capacity and what you could do. And then you have a strategy to win. Are you going to win? Is it by innovation? Is it by keeping your costs low, your pricing, your growth opportunities, your strategic partnerships? What's your strategy to win? And then you do a competitive analysis, okay? You look at what others are charging, if they have the same product. If not, can you compete? In this area, yes. Maybe what we had in mind then, Schlumberger wasn't doing that. But here, green, yeah, we might be competitive, but nah, C and C reservoir and Woodmark are better. So you kind of have a chart of your analysis of the competition, where you fit in, where others fit in, just to convince your investors that you understand what is going on, okay? So you come in here, you describe the business, where you are, where you're going, the idea stage, the concept, the development, then maturing the business. And then you come to your revenue model. Straightforward, keep it simple. Is the app going to be free? Are people going to pay? How much are they going to pay? How much are you going to train people? How much are you going to charge? Just keep it straightforward, keep it simple. And then you model all of that. So this is the part where, sorry, I'm having to move all of this a bit around the screen. So, okay. So this is interesting. So this is a simple Excel spreadsheet based on number of users. Everything I've showed you earlier was all Excel spreadsheet, just plotted out in graphs. So number of users, what part of the opportunity space, the product they're going to project they're going to buy, how much you're going to spend, and then you project that over 5 years. So this is the costs, and this is the revenue. So you can notice in the first year, less revenue than cost, and then the income is make a loss in the first year, make a loss in the second year, break even in the third year, maybe break even in the fourth, and then maybe in the fifth, sixth, we start making profit. So this is what you want to project. You need to create this model, but then you need to do it using sensitivity analysis. You could do over 3 different cases. So you could do a high case where if you achieve all our goals, we have 10,000 users, high case numbers, this is what it looks like. Low case numbers, if you don't meet the target, then maybe we just make 400,000 by 2022. And yeah, so 2020 we'll still be making loss by 4 years time, and in 5 years time, we get profits, and in 6 years time, we start making 2 million and above. So that's the low case. And then, so that's sensitivity analysis. You change the numbers and go, okay, if we sell 10,000 of this by year 5, this is how much we'll be making. But maybe we project low case, we won't sell 10,000, we'll only sell 2,000. And this is how much you made, this is the cost. And you project that, put it on a graph, your investors can see that. You can subject this analysis to a range of scenarios, where if this were to be true, this is how much we'll make. If this were to be true, this is how much we'll make. And then you tell them what you want. We're looking to raise this much money. This is the team I put together at the time. And this is what we're going to spend the money on. This is the funding. We're looking for 200,000 at the time to fund project development. And if you want to invest, minimum, you need 20,000 pounds each. And the exit strategy is that if you make enough money, we grow, we'll exit, and you make your money back. Good. So I've kind of rushed through that a little bit, but I would like to take a discussion or questions for those remaining on the call on everything you've seen so far in terms of running your own scenario, your own financial planning. If you're ready to go, if you have questions specifically to your own venture, I can give you advice now. And you can go away with the slides, which I assume you have. If you have any other questions or you want to apply them to your venture, you can come back to me and we can work together on the specific numbers. But I will hand over to Bosun now and Elvira to moderate the rest of the discussion. But thank you very much. I hope that's covered the fundamental of finance for you. You understand it enough to give it a go. And I understand you have a lot of questions and challenges going forward, where I'm here to support you. Thank you.
Absolutely brilliant. Thank you so much. I was actually clapping here. Yeah, so they will get the slide, and I have a few asks before we then open the floor to Elvira or either. The financial model, I know that it's in the documents, but if you have it as an Excel spreadsheet based, if you'd like to share, would appreciate that. That's one. You talked about the business model canvas. Yes, that's also the model that we are using to run this. What we have done differently is to I grade 4 parts: social venture, implementation, marketing, and finance, right? And then it fits into all of the subsets. So yes, to just give that perspective. But this is very detailed finance modeling for a venture, and I'd like to say thank you very much. If you like to ask a question, you take up the offer. We'll also check with a big group around being supported with your financial modeling for your venture. It's a good place to start, to share, actually, not to start, to share and say, oh, I need help and I would like to, compare my books, or maybe have you look at my book. Gideon has given us that offer to help us. So please take it up and let us know if you are interested. Are there questions before I ask my own question? Yes, thank you very much. Yes, but are there questions that you would like to ask? Everything is clear? So I'm keen to ask and probably put Lisani, who was second position from the Venture Lab, on the spot here. Is there, following this class, is there any difference to your financial modeling? Is there something you're taking away from here to make your proposal better? Lisani, are you still here?
I can say is I can say it's very low. So something from this class, as because my background is totally about environmental things, sustainability around this. I don't have economics or financial things. So I think we'll
I'm not sure if I'm the only one, but I can barely hear her.
Sorry? Yes, we can hear her too.
Yeah, same here. I'm struggling, sorry.
Okay.
Network is not very good.
Yeah. If you can type it, it will be great. And if there are other questions, please put it in the chat or raise your hand. So let's take it as our closing. This has been a very, very detailed and robust financial modeling class, because in basic venture lab, actually, they just teach you balance sheets and maybe income statements. And here we went through the whole 9 yards. So if you have question, we're keeping it up for the next 1, 2, 3, 4, 5 minutes. Okay, Lisanne is still trying to speak, but I think she's dropped off. But I'd like to say thank you at this point, since there are no questions in the chats. I know that, again, geoscience, this is also the bridge that we are trying to reduce the gap. Geoscience, these are completely geoscientists, scientists, and they're building ideas. Yes, they do have ideas, but it's now bridging the gap between the business knowledge and also the social sustainability knowledge. So it's a lot of information. We will share the detail, the presentations file that you have shared with us, we'll share with them. And if there are anyone that takes up the offer to speak with you for support, we would also pass that across. I still have Elvira on the call, and Ether, and Adrain. So I'd like to pass the mic back to Elvira if you're still here. Good. Today is not good data day. It's not working.
Yeah.
Ethan.
Well, Gideon, I would just like to take this opportunity to say thank you. Your presentation was wonderful. We appreciate your time today. Thank you again.
Elvira, the static is really bad. Can't hear you, but we hear your appreciation. So thank you very much. I think it's a good place for us to shut down the meeting in the next three minutes. If there are other information, we'll pass it across to the group. There is a meeting that is being planned for next week. Please ensure that you check your email and tell your colleagues who are parts of the Venture Lab to join. The feedback form is also here. It's on the, yeah, Anne just dropped it on the chat. Please ensure that you fill the feedback form. So we're going to use the next 2 minutes to fill this. It's a feedback for both the class, the faculty, and the overall administration of the program, because it helps us to build better for subsequent ones. So we're waiting and we are going to be checking. So you don't leave until you fill. But Gideon, Ether has said the vote of thanks. We can release you at this point. I'll be in touch. Thank you very much for your support. Really appreciate it.
Well, thank you too. It's a pleasure. And all the best, guys, with your ventures. And I look forward to reading about your success stories in the future. Thank you.
Appreciate it.
Bye.
So, Han, tell us who has filled and who hasn't filled, so
Nobody
that we
has
can
filled yet.
All right. So, guys, we're
Nobody has
waiting.
filled yet.
We have on the call, we have 5 at least now. Please fill the feedback form. And when you fill it, please put it in the chat and say done. We have about 1 minute more. So let's know if you and when you fill it. Put it in the feedback form and then we'll also see it to confirm.
We just had an individual join that hasn't been on the entire session, so I don't know.
Yeah, it's part of the pro lighting.
Okay.